Let me ask you something. What if I told you there's a 100 plus billion dollar company whose stock has exploded nearly 200% in just 1 year, yet analysts still think the current price might actually be above their average target? Sounds confusing, right? Well, today we're breaking down Corning, a company that's quietly sitting at the center of many technologies around the world. And once you look at the numbers, things get really interesting. So let's start with the basics. Corning currently has a market capitalization of about $114.97 billion, with an enterprise value of roughly $119.41 billion. That places it among the large and influential technology-driven industrial companies in the market. And investors are paying close attention right now for another reason. The company's next earnings report is expected on April 28, 2026, before the market opens. Earnings events like this often bring significant volatility and investor interest. Now, when we look at the stock itself, one number immediately jumps out. Over the past 52 weeks, Corning's stock price has surged an incredible 198.69%. That kind of move naturally raises a big question for investors. Has the growth been justified by the fundamentals, or is the market getting ahead of itself? Let's dig into the financials. Over the last 12 months, Corning generated $15.63 billion in revenue. Out of that, the company produced $5.62 billion in gross profit, $2.32 billion in operating income, and $1.60 billion in net income. That translates to earnings per share of $1.83. In terms of profitability, the company maintains a gross margin of 35.98%, an operating margin of 14.87%, and a net profit margin of 10.21%. So what does this mean for investors? These margins suggest that Corning is able to maintain a fairly healthy level of profitability relative to its revenue, especially considering the scale of the business. Cash flow also gives us an important clue about the company's financial strength. Over the past year, Corning generated $2.70 billion in operating cash flow. After $1.28 billion in capital expenditures, the company was left with about $1.41 billion in free cash flow, or roughly $1.65 per share. Free cash flow is critical because it shows how much money a company actually keeps after running and investing in the business. Now let's talk about valuation, and this is where things start to get interesting. Corning currently trades at a price-to-earnings ratio of 73.26, while the forward PE is around 43.15. The company's PEG ratio sits at 1.28, which attempts to compare valuation with expected growth. Meanwhile, the price-to-sales ratio is 7.14, and the price-to-book ratio is 9.89. So the big question becomes, is the market pricing in strong future growth? Because based purely on traditional valuation metrics, this stock is trading at relatively elevated multiples. Looking deeper at enterprise valuation, Corning has an EV over EBITDA ratio of 32.53 and an EV over sales ratio of 7.64. Again, these numbers suggest investors are willing to pay a premium for the company's business model and potential future growth. But valuation alone doesn't tell the full story. We also need to examine the company's financial position. Corning currently holds $1.53 billion in cash, while total debt stands at $9.38 billion. That results in a net cash position of negative $7.85 billion. However, the company's debt-to-equity ratio is 0.76, and its interest coverage ratio is 6.92, meaning its operating earnings are nearly 7 times higher than its interest expenses. So while the company does carry debt, it still appears capable of servicing it. Liquidity also looks relatively stable, with a current ratio of 1.59, indicating the company has more current assets than short-term liabilities. Next, let's look at efficiency. Corning currently generates a return on equity of 14.90%, while return on invested capital sits at 9.94%. Interestingly, the company's weighted average cost of capital is about 9.34%, which means its returns are slightly above its cost of capital, an important factor for long-term value creation. Another interesting point is ownership structure. Only 0.21% of shares are owned by insiders, while institutional investors hold about 74.58% of the company. That high institutional ownership often indicates strong participation from large funds and professional investors. Now let's talk about shareholder returns. Corning pays an annual dividend of $1.12 per share, which results in a dividend yield of about 0.84%. The payout ratio is roughly 61.20%, meaning a significant portion of earnings is being returned to shareholders as dividends. At the same time, the company has a shareholder yield of about 0.63% when including buybacks. But here's another interesting detail. Despite the strong stock performance recently, analysts have set an average price target of $115, which is about 14.18% lower than the current price. So what does that mean? It suggests that while analysts still have a buy consensus rating, they may believe the stock has already run ahead of their valuation models. Finally, let's take a quick look at risk indicators. The stock's beta is 1.02, meaning its volatility has historically been close to the overall market. Short interest is relatively low as well, with about 1.74% of shares outstanding sold short, which suggests there isn't a massive bearish bet against the company. And from a financial health perspective, Corning has an Altman Z-score of 3.34 and a Piotrowski F-score of 7, both indicators often associated with reasonably stable financial conditions. So, when you put everything together, what do we really have here? A company with a massive market cap, strong institutional ownership, solid profitability, and positive cash flow. But also a stock that has already rallied nearly 200% in a single year and now trades at relatively high valuation multiples. For investors, that raises the big question: is Corning still in the early stages of a long-term growth story, or has the recent rally already priced in much of the optimism? That's something the upcoming April 2026 earnings report could help clarify. But as always, this video is for informational purposes only and should not be considered financial advice. Always do your own research before making any investment decisions. And if you want more deep dives like this into major US stocks, make sure to subscribe, because the next company we break down might just surprise you.